Hi, welcome to the Red to Black podcast. Here, you will learn how to invest in highly profitable private businesses to create abundant financial freedom. If this topic interests you, we invite you to subscribe to our channel. This podcast is hosted by Werner Minchell, ex-Marine aviator and current real estate investor, and Mario Parzino, current Marine infantry officer and business investor. Okay, good evening, everyone. Tonight we have Mario and John Lilick as our special guest. Mario, would you mind introducing the topics for this evening's discussion?
Yeah. Hey, gentlemen, how's it going? Title for this podcast is Bitcoin and the not so fast death of value investing. Topics for discussion are: number one, Bitcoin, other digital coins and tulip bulbs. Number two, blockchain, encryption, transactions, and energy. And lastly, number three, Federal Reserve digital currency.
Great, thanks, Mario. And John, would you mind introducing yourself for us?
Yeah, my name's John Lilick. I guess, first of all, thank you for having me here. I'm a very old friend of Mario's. Professionally, I've been involved in Bitcoin and crypto and all of these things for about a decade. I sort of, I got into this stuff accidentally, roughly in 2011, when I was doing a bunch of e-commerce type of drop shipment activity. Shortly after that, I sort of ran into some problems with my banking services. I realized very quickly how much power the banks have, especially when you're an e-commerce merchant. And I kind of started looking around for alternatives. I found Bitcoin. I ended up moving to New York City in 2013. I worked at a place called the Bitcoin Center for all of 2014, right next to the New York Stock Exchange down in Wall Street. 2015, I joined and helped build a company called Consensus, working on something called Ethereum. And pretty much the last 6 or 7 years, I've been intensively doing that. So that's kind of, I've been in this stuff for some time now, I guess.
Yeah, John, thanks for coming on this podcast and helping us better understand digital currencies. It's our belief that Bitcoin or all digital currencies should be valued based on their utility and not scarcity, meaning that they bring a lot of utility to the world where I can transfer money over borders very easily, and I can create a transaction between two parties or multiple parties almost instantly, where it would take multiple days or even weeks to clear different banks, especially in international processing. However, right now we're seeing the value of these coins being traded based on scarcity. And I think we could all come to some sort of agreement that there's unlimited digital coins. I know that there's a limit on certain coins and how much they're going to be created, but as a whole, there's really no limit of how many digital coins can be traded. What are your thoughts on the valuation that we should place on the utility of a digital coin?
Right. Well, I think you're sort of bringing up quite a classical argument that's brewing online on places like crypto Twitter. And a lot of people have differing opinions. I mean, I think the notion of digital scarcity is quite interesting, and there's actually very good reasons and very good arguments in favor of digital scarcity. When we say a sort of potentially unlimited amount of coins can be created, yeah, there's some truth to that, but at the same time, it's very, very difficult to build network effects. It's very difficult to scale up a network to a stage where not only is the underlying security sort of very, very strong, like Bitcoin right now, would be very difficult and very, very hard, even for large nation state actors, to take some type of malicious action against. Whereas that's not the case with, for example, IOTA is a very famous, used to be a top 10 digital currency. I think it might still be in the top 20, where sort of the network just stopped for like 10 days, because of like some, type of, basically technical issues, and there was an attack, etc. And so to get these things up to a point where, as you said, they have these properties globally that enable users to have very strong confidence that actually their transactions will execute, that there won't be some type of double spend problem, etc., isn't actually as easy as we might think. with respect to utility and usage, the first sort of place where I would say a casual user can start to build a useful mental model, if you go to cryptofees.info, it'll show you all the sort of like top 10 coins, digital currencies, and how much they are generating daily and weekly in fees. And so the fees in the case of something like Bitcoin is when you send a transaction, you pay a transaction fee if you want your transaction to be prioritized, meaning that a miner picks it up very quickly and confirms the transaction very quickly. Otherwise you might get stuck in the mempool, which is sort of like the queue for your transaction to be validated, and that could take hours or sometimes many hours in the case of Bitcoin, especially when the network activity is very high. And likewise, when you see something like Ethereum, which I would say is much more dynamic in terms of the types of transactions it can process, but also the speed at which it can process those transactions. We see that actually Ethereum is generating considerably more fees, and Ethereum derivatives, so in other words, other tokens that are actually launched and sort of resident on Ethereum are also generating quite a lot in fees. So, the argument there would be that fees are a good representation of demand, and so if users are willing to pay for transactions to confirm, then this sort of signals some type of demand, which correlates to utility and should kind of reflect price. The caveat I would add there is, and this is actually quite a big problem with Ethereum today, is that kind of view leads to very quickly a state of, well, sort of what we say on crypto Twitter, like a whale chain. In other words, so it becomes a network that's primarily beneficial for those that are transacting in large amounts. Because if you've got $10 and you want to send somebody a micro transaction, maybe you need to pay $5 for some in-game fee, but the transaction costs you $15 in gas in transaction fees, then you're sort of like priced out. And likewise, when network congestion is very high, when demand is very high, in the case of Ethereum, you sort of have this network that has a variety of decentralized finance applications where you've got leveraged positions and you've got people trading all kinds of basically structured financial products. And then there's a sudden like price crash and people want to exit and unwind their trades. Well, that's when they start paying like insane gas fees. That's when transactions spike up to like $400 or $500 just to do a single transaction. And if you're just like a regular user, at that point, you're totally screwed. And so maybe you're playing some video game or you're just doing a very simple, very small transaction, and suddenly the gas fees spike up. So, and you're facing like a $500 transaction fee. Otherwise, you might have to wait like many hours or some indeterminate amount of time for your transaction to settle. So it's a spectrum, and I just am a little bit hesitant to sort of have a very strong opinion on whether scarcity is kind of a better indicator of value and price, or whether utility or probably some spectrum of the two. And I would say, the notion of scarcity, this was for me personally quite illuminating. And I know you guys from your background, you've been sort of deployed and you've traveled to other parts of the world, and so sometimes, especially back home in America or Canada, other first world places, we don't really get the same perspective because our monetary system is quite stable and our banking system is quite stable, and so. If you're in Argentina, or the classic example is Zimbabwe, or even, I don't know, more recently in Europe, for example, in Yugoslavia, the collapse of the regime there in 1992, you have 100 trillion dinar notes that were printed in 1992 in Europe. So that kind of a thing, the Weimar Republic moment, can happen very quickly. And so in many other places around the world, Lebanon very recently, of course, where their central planning in government and central bank completely collapsed, that scarcity, that digital scarcity, is actually quite valuable and quite important. So that's sort of the spectrum of different ways I would look at it. And I'm not quite sure whether scarcity or utility sort of wins out, but I'm quite certain in various contexts both are quite valuable.
Yeah, absolutely, John. You brought up an interesting point. Thank you for that discussion. You said leveraged positions, and I wanted to bring Warner in on this. So the overall topic we're first discussing here is Bitcoin, other digital currencies or coins, and tulip bulbs. Warner, can you kind of tie in what happened in the Netherlands in 1623 with leveraged positions to this discussion?
Exactly. So thank you, John. Yeah, those are great points. Mario and I are not versed in cryptos, so when you described that was fascinating to me, and I would guess fascinating to Mario, understanding how it works. So thank you for that. In terms of the tulip bulb, why we bring the tulip bulb in is because we're wondering if there's a comparison today between the tulip bulb and the crypto space. We think there is. We're curious in your mind after I'm finished speaking. So concerning the tulip bulb, what happened in the tulip bulb was in the 17th century, there was the rich class and there was the poor class. The rich class had a lot of money. The poor class was basically skilled laborers and low skilled laborers. And they would make the currency 1 guilder per day. And a tulip bulb was selling for 1,200 guilders per day. So 1,200 times the daily rate of a skilled laborer. And they were selling these Semper Augustus tulip bulbs, which were about 12 to 15 of them in the entire country. And they came over when the Ottoman Empire conquered that area of the world. Now, what made this truly exceptional, this whole tulip bulb craze, is as it went along, it went to 2,000 to 3,000 guilders per day for a tulip bulb, and then to 10,000 guilders before it crashed. What was really fascinating about it is at the lower end, the Dutch people were known for being very thrifty, frugal, and hardworking because they had high rents and high prices to live. So whatever they made, they used it wisely and efficiently. That all went out the window when they saw this tulip bulb craze that the rich were buying, because the rich, their only form of entertainment at the time was their gardens, and they had the resources to improve their gardens, and the tulip bulb was the craze. That craze started getting so crazy that it sucked in the middle class, and the first ones in were the weavers, and they had these loom machines, and they were using the loom machines as collateral for debt from the banks to purchase tulip bulbs. But they weren't purchasing the most expensive ones. There was like the second one down was the Valerius, and that I don't think they were even purchasing that. They were purchasing the lower level tulip bulbs, which were worthless. I mean, you're talking just regular yellow and red tulip bulbs, just very, very common looking bulbs or flowers. And when they started getting into that market, they were leveraging money to get into that market, and they started running that market way up. So there was the high-end tulip bulb, which is maybe, let's say, Bitcoin. And then there's the low end, which are more of the worthless tulip bulbs, which are maybe all the other cryptocurrencies. What are your thoughts on that, John, in terms of the relationship of the Bitcoin to and the whole cryptocurrency market to the whole tulip bulb craze?
Yeah. No, I think you summed it up pretty well there. I mean, I guess, this is another sort of classical kind of debate people have, and, kind of at a macro level, the notion of speculation and whether ultimately it serves society or not. And I would say, even before we get to the tulip stuff, just rewind kind of monetary history and monetary science just a little bit before that, and you sort of get you get like the Medicis, who invent double entry accounting because they had so much money from their merchant trade. And then you get Copernicus, who observes the expansion and contraction of the monetary supply and its effect on society. And then you get Isaac Newton, who sort of, and then you get tulip mania. And then after that, you get Isaac Newton, who sort of observes the the gold standard. And so, I would say that we've had this progression over time of society better understanding money and its properties, um, and that includes speculation. And then, of course, fast forward to today, where we have fractional reserve banking, and you could actually even argue that speculation has been this sort of like engine that has turbocharged 20th century and 21st century civilization to where we are now, which is kind of like fourth industrial revolution stuff, where we have reusable rockets and all kinds of really cool stuff. um, and so specifically on the tulip mania, though, it's actually interesting because at one point, in real terms, like one flower, one tulip could actually get you an apartment in Amsterdam. You could trade it for an apartment. I mean, that's how absolutely bananas it was. And the mania was hysterical. And I think it was sort of the first instance of, let's say, this type of speculative hysteria going mainstream. I mean, we definitely didn't have communication networks like we do today. We didn't have the type of information and the ability to disseminate information like we do today. But we were starting to kind of like, I mean, this was in Holland at the time in the 17th century, where, as far as European living standards and let's say telecommunications technology goes, it was probably about as good as it could get. Open ports, lots of trading, merchants coming in and out, etc. So information was flowing to like the best extent possible at the time. So those conditions were sort of ripe for this type of market frenzy and market dynamic to emerge. I think it was a proto sort of speculative leverage, kind of like structured financial product market, if you will. And definitely the frenzy, looking back on it now, we can criticize it and say, what were these people thinking? But at the same time, we've had tremendous financial innovation since, where speculation has been a key driver in all of that. So, like, I personally am a capitalism maximalist, if you will, and I do think speculation is just fine. I think leverage is just fine. I think what's really, really interesting, and by the way, this kind of stuff has, I know it's easy to kind of say, oh, the Wall Street guys are people are the bad guys or whatever, but if it wasn't for the capital, and if it wasn't for our ability to generate so much money, would we have been able to bankrupt the USSR, for example, right? Like, the course of history has favored Western society and our kind of view towards democracy and pluralist societies, in part because of our ability to speculate, participate in free markets, and make a lot of money. So it's not all bad, it would be my first contention. Now, specifically when it comes to Bitcoin and kind of like transposing the lessons learned of Tulip Mania and some of this stuff we just mentioned as far as speculation, I mean, I don't see parallels at all, to be honest, and I'll tell you why. First of all, Bitcoin is a perfect information system. Okay, every transaction is recorded on the blockchain. It is validated. It is sort of like very, 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 very hard for any actor or minority set of actors to improperly manipulate the system. Okay, so that's one key differentiator here. In the past, in that example in 17th century Holland, a small subset of actors could very easily manipulate the system, whether it was through having information before everybody else and then being able to sort of like control the dissemination of the information, or other means of basically having an unfair advantage or unfair asymmetric information advantage. That property does not exist in Bitcoin. Anybody at any time can inspect the state of the system, and it's sort of like remarkable in this sense. And actually, even if we fast forward into a much more modern context, for example, Bear Stearns or Lehman Brothers, I mean, we almost collapsed our system precisely because those entities and others were fundamentally misrepresenting their position, because we could not inspect the state of their network and their databases and their accounts, because it's not the same architecture as an open system like Bitcoin. And others were placing very large bets based on what these banks were representing, when actually they were totally misrepresenting and knowingly doing so. And so that created a cascading sort of like systemic risk. With Bitcoin, you can't do that. You just can't. And so at any given time, if I choose to, for example, take out a leveraged position, which you can do very easily on exchanges today, you can go on any major exchange, whether it's Binance or FTX or whatever else, and you can leverage, meaning that you can put some amount of Bitcoin and deposit it into your account, and then you can buy 10x, 20x, or 50x, or even 100x in some cases more than what you have. However, if the price moves against you, even a small amount, you could be liquidated. And lots of people all over the world at any given time are taking out these positions, and not even people anymore. I mean, very sophisticated trading bots. But the thing is, you can see all of that. So, you can, there's a variety of different trading tools available out there for anyone who wants to inspect the current state of longs and puts. I mean, all of these offers, all of these open positions, and you can sort of like, very, very, very quickly and easily assess whether there's, and even the Chicago Mercantile Exchange, the CME, which is the largest clearinghouse in the world by far, it's not even close. They have a Bitcoin futures market. And so you can actually look at that market and you can see, who thinks the price of Bitcoin, what the future price of Bitcoin might be and what kind of leverage they have accordingly. So, you know, I would say that speculation is totally fine. And I'm probably even very libertarian leaning in the sense that I don't think government should intervene in, when people decide they want to speculate. That should be totally fine, and they can assume risk for themselves. And as long as you sort of, and as an investor, as a trader, I want to participate in speculative markets where I have this kind of like perfect information, perfect visibility set of conditions or characteristics that allow me to, appropriately kind of like assess my risk profile, and not some type of, surprise because somebody else has an asymmetric information advantage that I don't, I'm not aware of, like, I don't know, the CEO of Enron, like I wouldn't want to trade against that guy because obviously he knew things that nobody else knew. And so I think that's the fundamental kind of differentiator here. And I'm wildly excited about it because I think Bitcoin as sort of the foundational bedrock for how we actually engage in this type of speculative trading, leverage, and is like fundamentally making capital much more efficient, for the reasons I described, because it just totally levels the playing field.
Awesome points, John. Thank you for sharing that. I'd like to transition us to discussion number 2, which is blockchain, encryption, transactions, and energy. I'll give a quick history of the origins of blockchain technology. It can be traced back to the cryptography work that was conducted by W. Scott Stornetta and Stuart Herbert in 1991, and their work actually begun in the mid-'80s. And then early development of asymmetric cryptography was conducted in the mid-'70s, specifically 1976, by Diffie and Hellman, who developed a key exchange algorithm as a means of securely exchanging information over a public network. John, can you kind of describe the safety we have now with this, the advantages of the public ledger and also some disadvantages? If we wanted to meet in Bermuda one weekend and work out a business deal, if we paid for this business deal in crypto, it's going to be recorded. If we did this in another exchange, simply a duffel bag full of USD, it would not be recorded. Can you kind of give us your thoughts on the blockchain technology and asymmetric cryptography?
Sure. So asymmetric cryptography is, also kind of a lot of people refer to as public key pair cryptography or public-private key pair cryptography. And so, this fundamentally deals with factoring very large prime numbers. So there's a type of mathematics behind it that's well understood. And so to kind of like break something like Bitcoin, you would just need to do an incredible amount of mathematics that will just take a very long time, and there's no shortcut. And when I say a very long time, I mean like, I don't know, trillions of years to try to guess somebody's private key. And so
Could quantum computers break the encryption faster than 1,000 years?
I don't think so. I don't think so, because there are, quantum computers work in a certain way, but they're good for certain things, not necessarily for other things. And then there's other advancements which sort of neutralize quantum computing, things like Shamir secrets and different approaches. So it's not like a big surprise or anything. Like suddenly I do think there's a lot of other stuff that is going to get broken very, very quickly, like email passwords and, I don't know, login to online banking, like when people just recycle passwords. But I think public-private key pair cryptography is generally going to be very, 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 very safe and unlikely to be compromised, suddenly. So I don't have those concerns. But like fundamentally, you sort of like, when it comes to the blockchain, you have this like public address, and it's a long alphanumeric string of characters. Associated with that public address is like a unit of value, 1, 2.1, some arbitrary unit of value. And that's like the number of Bitcoin that is associated with this public address that's resident on this shared ledger that's distributed across, machines around the world. And then you have this third component, which is a private key, which only you have. It's also, sort of a very long alphanumeric string of characters. And actually, the public key is a derivative of that private key. And so the very easy way that I like to describe it is, imagine you have you got a quarter and you flip it. Okay, it's 50-50 heads or tails. This isn't a very secure system, but imagine you have 256 quarters in a row. You flip them, they land at the same time, and now you have to guess the sequence of heads or tails. That's very, very hard. Now imagine thousands or millions of rows of 256 quarters all flipping and landing at the same time, and you have to guess the correct sequence. So that's kind of like one way to visualize what's going on. And as the network gets bigger, okay, you have more and more of these rows of 256 quarters flipping and landing at the same time, and you have to like constantly try to guess. And so, one of the properties of Bitcoin that's really interesting is it has this difficulty component to it, where the network, if more computers come online, like if more computational horsepower or hash power comes online, more people start mining, the difficulty increases, right? So now it's like it's got to, instead of trying to guess for 10 rows of 256 quarters, it's got to guess for like 50 rows, right? So it gets much more difficult. When the network senses that people are turning off their machines, like there's less miners, less hashing power, the difficulty adjusts and actually gets a little bit easier. So it has this like ability to kind of like adjust accordingly, which is another sort of fascinating property that, when you look at it on the whole, the thing is there's $1 trillion bounty. I mean, the market cap of the thing, and it's been many billions for many years now, for anyone who can break it. Okay. And so nobody's been able to break it. I mean, it's very, very resilient. It's out in the open at all times. And so I would say that, going back to the point you made earlier, Mario, in terms of value, I think another component here is Bitcoin is valuable because people trust, like tomorrow, if by the grace of God, knock on wood, I wake up still alive, okay, two things are going to be true. One, the sun is going to be there, and two, Bitcoin will be like there. So that's another kind of property that I think people value tremendously. And so now there are some trade-offs, and you mentioned sort of privacy, and this is kind of one of the big things that people need to understand very carefully. Bitcoin is pseudo-anonymous. Okay, so pseudo-anonymous insofar as every single transaction that has ever happened on the Bitcoin network and that will happen on the Bitcoin network or other networks that are derivatives of Bitcoin and other blockchain networks is there for everyone to see and will be there for all of time. Okay. It's like this whole narrative, oh, drug dealers use it, da 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 da. I was there. I was actually in the courthouse when Ross Ulbricht, during his trial in New York City. He's serving multiple life sentences now for operating the Silk Road. Not just him, they caught everybody. They caught all those people because they were able to, see all the transactions. And at some point you make a tiny little mistake, and it's not like somebody's checking this manually. They have like very sophisticated machine learning, chain analysis systems that are scanning everything and producing heat maps, and so they'll find you, and so it's the worst thing to use for nefarious activities. Actually, the best thing to use is, as you said, cash in a duffel bag. But we can, we should have the right to privacy, be able to transact in private without the state necessarily overseeing all of that. I mean, I happen to have been born in a communist country. I know the it's very, 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 very bad when the state has this kind of totality of control over people's lives, and I think many people around the world agree with that. So privacy is a fundamental human right, really. So with Bitcoin and and other crypto currencies, you can have a spectrum of privacy, and that's largely contingent upon, first of all, how careful you are and how smart you are in terms of, like, if you use an exchange, right? Like you use Coinbase. Well, Coinbase has all of your identity because you have to KYC and AML, etc. And every time you send money in or send Bitcoin or crypto in and out of Coinbase, their tracking systems start tracking you, and that information can be shared with authorities. I mean, that's just how it works, and banks do the same thing. So this is like an industry standard. It's not regarded as some crazy intrusive thing. So, you wouldn't want to, like, use Bitcoin to buy dope and then send it to Coinbase. That would just be like a very stupid thing to do. Likewise, you wouldn't Venmo your drug dealer. I mean, those are crazy things to do anyways. And so that's just very basic stuff. However, if you are a dissident, like maybe you are in one of these, tyrannical regimes overseas, and you are helping kind of, like, I don't know, uphold freedom of speech, or you're just looking for a right to assembly, and people are helping you financially to organize, like in Venezuela, for example. You have to be aware of these things, and so there are definitely alternatives where privacy is very, 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 very strong, like Zcash, for example. However, there's trade-offs where the thing is, really complex to use, and it could be very slow, and not a lot of people are using it. So, like anything else, it's a spectrum. And I would say that for most folks, you know, Bitcoin is super duper great, especially as a store of value. You could use other things like Ethereum for much faster transactions. And there are innovations happening like Zcash, which sort of like fundamentally uh, makes use of something called zero knowledge proofs, where you can sort of like prove something is true without revealing the contents of the thing that you're trying to prove, that you care about. Um, and I think the evolution of sort of like, and then of course, if you want total privacy, you can just use US dollars and cash, right? And so, and by the way, I love US dollars. There's nothing wrong with US dollars. And I love cash. There's nothing wrong with cash. Just because cash has this like extremely, kind of like solid property of being very, very, very private, I don't think it should be outlawed for that reason. And so, I would say that between cash and Bitcoin, for privacy, definitely cash is much, much more private. Bitcoin much less, although you can certainly, uh, you can certainly avail of things like much more privacy focused tokens like Zcash if it's a if it's something that you're really looking for. So that's the kind of like spectrum of choice that that's out there right now.
John, thanks for still validating that you love USD. I appreciate that. Warner, I'd like to bring you in on scaled blockchain efficiency versus Visa, MasterCard, and Swift as a clearinghouse, and your thoughts on if Bitcoin or any other digital currency that's backed by a blockchain can ever become as efficient with the transaction speed and energy as Visa, MasterCard, and Swift. What are your thoughts on that, Warner?
Yeah, thank you, Mario. John, I have a question for you concerning the transaction speed of Bitcoin. Heard this online that it takes 4.5 transactions can happen in a second in Bitcoin and 1,700 with Visa and MasterCard in a second. What are your thoughts on that? And then also, what are your thoughts on, because the primary goal of this podcast is to support individuals invest in highly profitable private businesses so they can create abundant financial freedom. So our goal is when we have cash, where do we put it? Can we get it into Bitcoin quickly? Can we pull it out of Bitcoin quickly? And then can also, the first question, can Bitcoin compete and transact quickly as, say, a Visa or MasterCard?
Right. Yeah, no, I mean, this is kind of, again, I feel like this general notion of trade-offs and spectrum of choice is emerging from this conversation, which is like in my mind, a really good way to describe and try to build mental models around all this stuff. And you're absolutely right. Bitcoin, 4 transactions, maybe 5. Sometimes when the network is really congested, it might even be, 3 or 2.5. So in other words, it's orders of magnitude much slower than these kind of like traditional fiat rails like Visa, MasterCard, which, again, it's a trade-off. In the case of Visa, MasterCard, they own not only the database, the application, but the network as well. So they have the totality of the system within their control. And of course, with modern database technologies, it's much easier to use, traditional databases that are not distributed in nature, where you have a central authority and an administrator who has, by the way, administrative control. Like if they want to, cut you off, they can block you. And I mean, we've seen, in the United States, lots and lots of instances recently, and in other countries where, whether it's big tech or banks or whatever, I mean, they can just basically cancel you and deplatform you. So if you want that very high throughput, very, very, very large number of transactions and very cheap, per transaction, well, then the trade-off is, you run that risk of being deplatformed or having your card frozen or whatever. In the case of Bitcoin, I would certainly not say that right now in its current state it is ready to compete like on a retail level, especially for micropayments. However, there is ongoing, and by the way, everybody is aware of this, and this is, like, in my opinion, one of the biggest opportunity spaces like that any investor could. I mean, it's just wildly exciting to imagine if these, like, let's say layer 2 sort of Bitcoin derivative type solutions emerge, like the Lightning Network, for example, which is something they've been working on for some time, or Taproot, which is sort of like a thing that would allow Bitcoin to do smart contracts and allow much greater throughput, etc. Where you also have some trade-offs, but you get much higher throughput, much cheaper transaction costs, and now you can sort of like potentially use Bitcoin in a more usefully in a retail context where the transaction can settle fairly quickly and you don't necessarily pay a very high transaction fee. So that, I think, is a tremendous opportunity space for an investor to look at. It's something that I actively look at, and I'm sort of like constantly trying to build an investment thesis and mental model around, like, what happens if we scale Bitcoin to where it can kind of like credibly compete with these things, right? And actually, the Bitcoin conference in Miami is happening right now, and Jack Dorsey, the founder of Twitter, I mean, he's not my favorite guy because it's really weird. He sort of is a pro Bitcoin champion, but he's like, Twitter just censors and deplatforms. Like, I mean, I don't know. I can't believe the extent to which they're doing it. But so it's a bit of a contradiction. But nonetheless, clearly the guy is a very credible, intelligent person, and he's literally stopping everything else that he's doing to focus on scaling Bitcoin. And there's a lot of really smart people that are working on these problems. And so if they get it right, and it's not like they need to even just sort of like in the next year or in any kind of short term get it right to where they can compete with Visa, MasterCard. Even some small incremental improvements, I think, will like tremendously reflect in the value of the network. Right now, the narrative, and I agree with it, is Bitcoin is like digital gold. You sort of like, you have some Bitcoin, you park it, you don't really use it to transact. But as I said earlier, again, knock on wood, if you're lucky enough to wake up tomorrow morning, your Bitcoin will be there. And if you take very strong measures and protocols to protect your private keys, meaning you never put it online, you never take a photo of it, you never share it with anyone, you write your private key down, and you store it somewhere very safe, you know, your Bitcoin is not going to is very, 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 very unlikely to ever get hacked. And so, as a store of value in that sense, it's just like wonderful. And by the way, here's a statistic: anyone, okay, and this is that you can fact check me on this. Excuse me. Of course, the price is volatile; it goes up and down like crazy. But nobody who has bought Bitcoin and held it for a period of 4 years has lost money. Okay, so if you buy and hold for a minimum of 4 years, there's not a single person that has lost money when you look at the price charts and everything else like that. So, um, as a store of value, it's clearly working, would be my contention. As a retail payment method, to your point earlier about like transaction speed, etc., Visa, MasterCard, it's definitely not there right now. It's likely not going to be there anytime soon. But the progression and the work that's happening towards that kind of like ultimate goal, I think, is one of the most exciting, retail investment, spaces out there. And I'm very, very bullish about it, and so that's, to me, a tremendous opportunity. And if they get it right.
You brought up energy use with the word gold. So you mentioned that it's kind of a store of value like gold. I would argue that gold, silver, platinum, and copper are conductors of energy. They transfer energy very efficiently. Can you talk about Bitcoin or any blockchain-backed digital coin and its use of energy compared to gold specifically, or the USD, just bank accounts and transacting across traditional banking networks?
Yeah, sure. So let's start with gold, for example. And it's sort of like, I love gold too. Don't get me wrong; I'm a big fan of gold. But you have some limitations. You need to kind of like, from an energy perspective, have these like very, very, very big kind of machines that go out and dig, and you have these gold mines. And in many instances, especially in countries that are not like G7, you have just terrible conditions and sort of labor issues, and I mean even child labor issues. I mean, there's a lot of problems associated with gold and digging it out of the ground. It gets harder to dig gold out of the ground over time, because unless we sort of figure out how to mine an asteroid anytime soon, which may not be out of the realm of possibility, but I don't think it's going to happen anytime soon. The amount of gold on planet Earth seems to be, it seems to be more and more difficult to find gold all the time. So there are tremendous requirements for very, very large quantities of energy to go in as an input to extract the gold, and then you sort of have to like transport and secure it and store it, etc. I mean, you can't just casually kind of take, I don't know, 4 kilos of gold and sort of like conveniently store it. I mean, even just to take possession of that, somebody would have to transport it, etc. So the requirements to sort of dig it out, transport it around the world, and like continue to maintain this industry are very, very, very large, and they're generally petrochemical based for the most part. I mean, almost entirely. And I think that's the case with most precious metals. And then, of course, you have these other issues in these, in countries that are less developed, where actually it can be quite. I mean, everybody's familiar with the famous blood diamond kind of narrative, and this exists with gold as well, chromium, copper, etc. So, that's another kind of factor there too. When it comes to Bitcoin, I mean, there's a couple ways to look at it. On the one hand, mining is definitely energy intensive, and very large, quantities of the mining are happening in China, where of course coal is king. So that's definitely not good. However, there's more and more evidence, and actually it's very, very clear that lots of that activity is leaving China, and it's going to places where you have very cheap, clean, renewable energy. Like, for example, Washington State. Washington State has a lot of hydropower, and it's pretty cheap. And you're going to find actually quite a large number of mining rigs there set up in central Washington and eastern Washington. Likewise, Quebec has, in Canada, has fairly large Bitcoin mining operations as well, and a lot of that power is nuclear. So this trend is continuing, and it's accelerating. So, Bitcoin kind of, people will tell you that Bitcoin incentivizes finding cheap renewable energy, because as a miner, you sort of like, you want the cheapest, most stable, kind of like abundant source of energy. Um, and sometimes that can be a problem when you're dealing with coal power plants, especially, if your ultimate supplier of power is the CCP. And by the way, they have routinely forced mining operations to shut down. And so it wouldn't necessarily be a stable, reliable source of power, like, for example, being plugged into the grid in a place where there's, basically very large nuclear power plants providing an abundance of energy that's zero carbon. Now, the other kind of, I think, very, very salient point that's worth discussing here is that actually, and you talk about banks and all of these different things. Well, when you look at the banking kind of like infrastructure around the world, there's banks at every corner of every city, all over the world. Okay, so you need a lot of input, energy expenditure to, first of all, build these physical retail locations. I mean, cement production is one of the most energy intensive things we have. And so there's banks everywhere, like literally everywhere. Now, we can make the argument that, of course, everything is going digital, which is true, but these retail operations are still there. Okay, and actually, when you look at the statistics, in most countries around the world, especially developing countries, there's a trend towards more and more retail banking locations opening, rather than, let's say ING in America or in Europe, where like it goes all online or whatever the case might be. So, in other words, legacy banking has a very high energy requirement, and in fact, very, very, very large wasteful energy, um, profile. Because when you, especially, maybe less so in a kind of like forward-thinking place like Washington State, or certainly in places where it's hot, and they have to think about these things a little bit more carefully, like Florida, where everything is well insulated and people think about energy profiles. But when you go to other parts of the world, I mean, they leave the air conditioners running all night. They leave the lights on. They leave that. So there's a lot of wasted energy, okay, that goes into these retail operations. And again, thinking about this globally, because Bitcoin is a global system. I mean, it's not just a local thing. So, that's kind of one other consideration. And then when you look at it from further expanding on the wasted energy kind of narrative, Bitcoin is actually, let's say, the buyer of last resort. In other words, wasteful energy that's produced that otherwise doesn't get consumed, will definitely get consumed by Bitcoin, because miners have this like direct financial incentive, because basically energy, sort of like produces money, right? That's like the fundamental equation. Whereas, many other businesses, that's not the case. Like there's lots and lots of, instance. I mean, that's the whole reason why we have demand response, programs, because a lot of businesses, there's different times where they have peak load and other times where they don't. And so with Bitcoin, you sort of like always have a buyer of last resort, which means energy that's produced that would otherwise be wasteful, that would just dissipate and not be used, is consumed by Bitcoin. And when you sort of look at, when you look at the macro like figures, I think it's something like there's like the total energy generated worldwide is something like 165,000 terawatts. Okay, I think 60 or 70,000 of those terawatts are lost because of inefficiencies. And Bitcoin, comparatively consumes like 115 terawatts. Okay, so out of the 50 or 60,000 terawatts of energy that's lost due to inefficiency, that Bitcoin is consuming 120 terawatts total. So, I mean, we're talking about like less than 0.1% of the total energy produced worldwide. Okay, whereas it's consuming, I don't know, 0.2 or 0.3% of the, total like energy that's wasted worldwide. So in relative terms, it's a very, very, very small, now I definitely agree that, China is a big problem. Okay, we got to get Bitcoin out of China, in my opinion. I think that's very important, and I feel like that's happening at an accelerating pace. As long as this current kind of like, uh, and I don't mean to be contentious, but as long as this current kind of regime is there, where uh, you have, tremendous uncertainty whether you're going to be shut down the next day or not, or whatever the case is, and you have very, very large reliance on coal. Um, and I think that's happening. That's happening because there's a direct financial incentive for it to happen. So that's very bad. The fact that so much is in China, but I think it's accelerating out, and I'm optimistic about that. But then when you look at these figures I just mentioned and kind of the totality of it on a macro scale, I mean, we're talking about a permissionless, kind of like self-sovereign monetary system that's global in nature, where in many countries it's a matter of life and death. I mean, in Zimbabwe used to be the breadbasket of Africa 30 years ago, and then crazy dictator comes in and ruins the whole thing. And now, if you had kept your money in Zimbabwean banks, it would literally be completely worthless, and it would have been worthless 20 years ago. And so it's a matter of life and death in many instances for many people. And I feel like that to to use up less than 0.1% of the world's total energy production, and in fact, most of the energy that it consumes is the wasted energy, is a very small price to pay, for that kind of a technology, and for what it brings to society. So, I'm trying to give a very fair and balanced, because there is downsides to it, and the China stuff is definitely bad. But on the whole, I think, I think it's, like I said, it's a very small amount of actual consumption relative to its utility and what it brings society.
Thanks, John, for kind of talking about transactions and energy. I want to transition us to the Federal Reserve, the Central Bank of the United States, and digital currencies. Obviously, the United States and the Federal Reserve specifically don't want to lose the benefits of having the global reserve currency. So they're going to probably compete in this space. John, what are your thoughts about if the Fed came up with a digital coin and created a bank account for every U.S. citizen at the Fed, and they dropped digital US dollars into that account? Would that compete with Visa, MasterCard, SWIFT, Bitcoin, traditional banking, alternative banking, etc.?
Well, first of all, let me just say I love the Fed. I think a lot of Bitcoin people are unnecessarily contentious with kind of like the central bank of the United States, and I certainly understand when people are disgruntled by central banks tinkering with monetary policy. However, at the same time, I think generally speaking, we've had tremendous stability. We have generally been a very big net positive globally, with this current monetary system and its and the regime behind it. And I think actually, going forward, I'm very, very excited about the prospects of US dollars going onto the blockchain. And that, by the way, is happening at an unbelievable rate with these stable coins going on Ethereum and other networks. I mean, it's growing tremendously. And in my mind, they say globalization, da da da. Actually, I think it's Americanization. I think the blockchain enables the US dollar to proliferate around the world tremendously fast everywhere, much more efficiently than the banking system. So let's say I'm, I don't know, a 13-year-old kid in, I don't know, Bangladesh or something. I know how to code, and I built an app and da da da. Well, if I try to get into the banking system there, I'm screwed. Nothing's going to work. Forget it. Well, I can just download for example, in the case of Ethereum, an Ethereum wallet. Within like 5 seconds, I can receive US dollar tokens, USDT, USDC, etc. And these are tokens issued on Ethereum and other networks as well by, for example, Circle, which is a very large, basically like a bank. And the tokens are backed by an omnibus account with actual US dollars in them. So you can redeem these tokens for US dollars with this bank. And so, people have a lot of trust in that. And, I'm fine with it too. And these, entities do audits and stuff like that. And so people have with confidence buy, sell, trade, and use these USD stable coins. And so, so now I'm that 13-year-old kid in Bangladesh. Within, a minute, I basically have a US dollar bank account. And so maybe my app that I'm building, I can now sort of like get online and I can use things like Twitter, or I can use other platforms where I can make it known that I've built this thing, and maybe investors want to invest and they can send me USD, or maybe customers want to use my product and they can send me USD. So, hyper dollarization globally, I think. And when you look at the statistics on USDT, USDC, these dollar stable coins, I can't remember exactly off the top of my head, but I think something like this time last year, there was about a billion or maybe 2 billion or some small number of billion total issued. And today it's almost like 100 billion. Okay. And if you extrapolate out and run it for like the next 2 years at this rate, we're going to be over a trillion. Okay. So hyper dollarization on the blockchain is happening. And I'm really excited when you pair it with this fourth industrial revolution stuff like Starlink, where basically U.S. telecommunications now covers the entire globe, and so you get U.S. dollars all over the world and U.S. telecommunications all over the world. Like boom, here we are. We're in the future, and so if anything, okay, to me this looks like upholding, okay, and proliferating the current and upgrading, in fact, the current, system where, again, if I'm that 13-year-old kid in Bangladesh, first of all, maybe my internet really sucks and I might even have internet problems. Well, okay, I can connect to Starlink for, I don't know, it's going to be like basically almost free. I can download an Ethereum wallet, I can get USDT, and now I'm plugged in and I can be a functional, participate in the global economy going forward for the rest of my life, anchored in basically the U.S. system. So I feel like the Federal Reserve, the people there, the government generally speaking, understand this. Okay, I think they're very smart. They're being patient. They're allowing the early kind of adopters and early risk takers, the entrepreneurs, people like us, like Consensus and others, kind of like, okay, let's give them some time, build this out. We might make mistakes, and if those mistakes happen, they won't be systemic. Okay, it'll be something that because that's what happens when you develop technology, right? But you run it for a few years, maybe half a decade, maybe a decade plus. You have a lot of resilience, and the system is battle tested, and then you start slowly. And what started as slowly with these US dollar tokens on the blockchain is now accelerating. I mean, we're drinking out of the fire hose, like it's unbelievable. Um, and I'm very, very excited for it. And I think, and by the way, I also feel like what I'm saying is being validated right now in real time. Okay, if you look at Governor Abbott in Texas, he just tweeted yesterday or this morning that blockchain is an integral part. They just passed legislation mandating that, like they got to do, investment in blockchain. The legislation is cleared. I mean, things are, it's accelerating, and the development is tremendous. Of course, Wyoming, and by the way, a lot of people, they say Delaware, Delaware, Delaware. Actually, Wyoming was the first to innovate, corporate structures and all of these things, like way before Delaware. And so it has this like rich history of being very progressive, kind of like a Swiss canton, actually, in terms of like financial innovation. And Wyoming is way ahead of the curve. All the other states, you look at the mayor in Miami, this guy's doing an amazing job. Like Silicon Valley is like moving to Miami. It's happening at an incredible pace, and it's all anchored in blockchain related activity. FTX, which is a very large exchange, they just bought the naming rights to the Miami Heat Stadium and all these different things. So that stuff is happening in America. It's happening at a tremendous pace. And when you look at it, okay, look, like I'm here now in France. I love France, don't get me wrong, but the European Union is like, they're talking about a digital euro maybe 4 or 5 years from now. Are you guys kidding me? Okay, 4 or 5 years from now, there's going to be like $1 trillion+ on the blockchain, maybe 2 trillion. So, at that point, plus, Starlink and all these other things. So, like I said, I think blockchain is one component that enables actually globalization to what it actually is Americanization. And I like I said, I'm very bullish about it. I think it's fantastic, and it just enhances and upgrades the current system, which is generally speaking, been very, very, very good for the world.
John, thank you for those reassuring comments about the USD. Warner, before we land this plane, are there any other questions we can flush out in the time remaining?
No, I would just like to recreate a bunch of the things that I heard, which John said in terms of blockchain that I don't think Mario and I really knew, which is the number one thing I got out of this whole conversation, John, was the transparency of the blockchain. And what was really poignant for me was the fact that you could go 100x. I would never recommend anyone doing that, but you go 100x leverage, and then your position would clear before you could take that position somewhere else. But in the current financial system, it's like we're leveraged over here, then they're swapping that position here, then swapping that position there. But it seems to me like on the blockchain, it's like when you leverage, no, you leverage in your own little box, and you're either effective at it or ineffective at it. And if you're ineffective, all your money gets taken, and then it's on to the next position. And I think that's extremely powerful. I think right now for storing your money, for Mario and I, a short-term storage of cash is maybe not the best position because of the fluctuation up and down. And we may not have that 4-year time horizon to deploy that cash. It may be in a year. So we want our cash to be stable so we can access it in a year and deploy it into a business. I think the safety of the blockchain is insanely powerful. And I think the power position or the amount of power use, that's really interesting because I know in Wyoming, the gas that they're burning off these wells, because when you take oil out of the ground, people don't realize this, there's all sorts of other minerals and gases with it, like natural gas, methane, all sorts of other things. And they're using the methane instead of just burning it off the top, the natural gas, they're actually using that as energy to power the blockchain. So I think blockchain's a really interesting technology, and Mario and I will definitely be researching it. But John, we want to acknowledge you for taking your time to come on this podcast. We're just in the initial stages of building this podcast, and our goal, as Mario said, is to uplift young men and provide leadership through finance. How do you invest in high quality businesses that churn off insane amounts of cash so you can create wealth and then go out in the future and get involved in your passion project, things like blockchain and every other thing that's impacting this world. And I just want to thank you for your knowledge, your information. It's very succinct. It's very clear. Any closing thoughts, Mario?
Yeah, John, thanks for taking the time. I'd like to bring you back on and specifically talk about citizenship in the south of France or in the Mediterranean versus the Caribbean and United States or Canada, and kind of get your thoughts in the future on where to position yourself with passports and citizenship for maximum freedom. So we look forward to bringing you back on. We'll give you the closing words.
Oh, well, no, I mean, it was wonderful talking to you guys. Thank you very much. Super cool podcast. I'd be very happy to keep the conversation going, and, very happy to talk to you guys anytime. That would be super cool.
Thank you for listening to the Red to Black podcast. We really appreciate you taking time out of your day to listen to our podcast. If you would like to connect with us in the future, you can find us on LinkedIn. Simply search for Werner Minchel or Mario Parzino. Also, you can find a link to our LinkedIn profiles in the profile section of the podcast. Thank you again for listening, and we look forward to connecting with you in the future.